Inflation is high. Growth is slowing. The markets are volatile. Welcome to stagflation, a nightmare for investors. If you're holding high-growth stocks, you're probably feeling the pain. But today, I'm going to show you my 6-step strategy how to not just survive stagflation, but position yourself for the next bull run. When is the next bull run?
Up. Pee-pee, skee-bee, dibby, dibby, da-dub-dub. This is not your place to speak now, pee-pee.
My name is not Pee-pee. It's Piranha. Mr. Piranha. Mistress Profit.
Okay, pee-pee. Anyway, let me butt in here. Regarding when bull runs begin, well, that's a question we can start a market current series for. It's a difficult question to answer. As of March 2025, President Trump has just launched his second salvo of tariffs. His tweets are sudden, unpredictable, and he likes to keep the whole world guessing how or if he is actually going ahead with his
tariff.
Market is very confused right now. S&P 500 has just dipped again. From the way things are going, it's going to be a consolidation phase for the time being until President Trump gives further clarity. Okay, PP, you can resume your talk now.
Stagflation is a toxic mix of slow economic growth, high inflation, and rising unemployment. Unlike a normal recession, inflation doesn't cool down, making it harder for the market to recover. This makes traditional investing strategies tricky. But here's how we adapt. Step 1. Stop chasing unprofitable hype stocks. Rising interest rates make speculative growth stocks, like unproven tech startups, dangerous. Instead, focus on profitable, cash flow generating companies with pricing power. Think Apple, Microsoft, or companies with strong recurring revenue models like Adobe and ServiceNow. In stagflation, you need defensive exposure. Here's where money tends to flow. Number 1, energy and commodities sector, oil and amp, metals rise with inflation. Number 2, healthcare sector, people always need medicine. Number 3, consumer staples sector, people still buy essentials. A smart move? Blend your growth stocks with inflation-resistant assets like energy plays, healthcare, and strong consumer brands. Think stock examples: ExxonMobil, Eli Lilly, Costco. Real assets with intrinsic value are an underrated hedge during stagflation. Commodities, real estate can act as inflation protectors. Number 1. Gold, a classic inflation hedge. Number 2. REITs, passes inflation to tenants. A word of caution regarding Bitcoin. It is my personal opinion that Bitcoin is a highly speculative asset with zero intrinsic value. Short-term wise, Bitcoin is not a reliable inflation hedge due to its volatility and correlation with high-growth assets. Long-term wise, it could become an effective hedge if adoption stabilizes and it transitions into a mature, less speculative store of value. Right now, cash isn't just a safe haven, it's an opportunity weapon. Do hold 10 to 20% cash in order to buy dips. Markets tend to overcorrect in stagflation. Having dry powder lets you scoop up quality stocks when they get oversold. For advanced investors, you can also use inverse ETFs like SQQQ or sell covered calls for extra income. For example, buy SQQQ ETF to short Nasdaq in downturns. Sell covered calls to generate passive income. The biggest trigger for high-growth stocks? The Federal Reserve. If they pivot, meaning they pause or cut rates, growth stocks will rip higher. If rates drop, high-growth stocks rebound. But if they stay hawkish, the pain might not be over. Stay flexible and adjust quickly. Remember, every crisis creates opportunity. Stagflation won't last forever, and the next bull run will be fueled by high-growth companies that survive this phase. So, what's your move? Are you adjusting your portfolio, or are you riding it out? Drop a comment below. Like and subscribe for more market insights. Turn on notifications so you don't miss the next episode.